Hi, and welcome to the show. Today we've got Nic DeAngelo, who's the president of the Saint Investment Group and who has spent time in family offices and watching the markets over the years. We're talking geopolitical events from AI to crypto to real estate, all the things that the future has in hold for us. Nic, thanks for joining us here today from Orange County, I take it. How are things down in Orange County right now?
JP, things are great. We're busy. We do got some good weather. I mean, we pay for it, but I'm happy, man. The market's a wild ride, but we're happy with what's going on.
That's what we want to see, right? And let's keep the good times rolling. It's pretty incredible times, and when I think of, we're talking all-time high in the equities markets. We're looking at real estate piling on. We've got whole areas, all this capex on AI. Like, when's the crash? Like, when does the party end? Like, it just doesn't seem like this can continue with at the backdrop of all the geopolitical events that are occurring as well, right? Like, what is your crystal ball telling you right now? What should we be preparing for?
Well, you know this, JP. I have no crystal ball, but here's what an amalgamation of all the analysts have to say in a lot of different ways. Number one, I'm pretty vocal about beating up on the U.S. stock market. Okay, and it's not that I don't think there's amazing companies in there. It's just if you peel it back to a more historical look and you try to put on Uncle Warren Buffett's glasses a little bit and look at the stock market through something like that, like a real high level value perspective, then you see the market in a different way. And here's what we see. Here's what the data shows us. 1995 was a big year in the US stock market. And since then, what we've seen is that the decline in number of companies in the US stock market has declined by over 40%. That on its own is a shocking keep you up at night type statistic. Okay. Now, if that wasn't enough, we have a diversification problem in the market already because it's 40% less, but we also know that the top 10 companies in the S&P 500 represent approximately 75% of the index's total market capitalization. So 10 companies out of 500 account for 3/4 of the index's value. The other 490 companies today represent 25%. Hard stop. I mean, really enough said. So on that side, it's no. I'm not shy about the fact that I'm very bullish on real estate. Let me start there. But at the same time, I just don't see the diversification in the stock market. You can cross-reference that with things like the CAPE ratio, right? Cost adjusted price to earnings shows somewhere between 30 to 38% overpriced in the stock market. So we went from this, and if we zoom out again to kind of look at what this looks like in recent years, what we know is that we had the everything bubble in the US. We printed 80% of every US dollar in history in the last handful of years. And the result was obvious. Everything was overpriced. And now we're seeing all the inflation, all the different areas. We hit 9.1 inflation, 9.1% inflation. That was supposed to be transitory. No, it wasn't. We found out later. And where we're at today is everything has settled back into real ranges of returns that are basically historical, except the stock market. So where does that leave me with the stock market? A little unsettled, because what we found is that most other asset classes have settled back into historical norms. We now have a mortgage rate in the United States around that 6% range, which is offensive to us because we're used to that 3% for the last, decade and a half. But the reality is if you zoom out 100 years, again, it's roughly 6% average. We're back to historical norms. The stock market hasn't adjusted. So that does scare me. Now, there's questions of, is that an AI play where there's just all this extra value that's just secret and data driven, et cetera? And, this time it's different. I don't know. I think we've gotten in trouble historically saying that over and over. But those are the questions that keep me up at night, is just what's the future of the stock market? And does it adjust like every single other asset class has?
It has to, doesn't it? Like you just, I mean, I think that's a great synopsis. You talked about this transitory inflation, right? And we suspected that was wrong. It turns out it was, right? And I mean, we're seeing the spend on the AI, right? We're seeing the capex. So we know that there is money being spent. I don't know how much of it's going to be seen through to completion, I guess, is another part of that discussion. But we do see that that is being spent there. The way we talk transitory inflation, I am, as I put it, I want to have the discussion. The more great people I talk with about this is, what are we talking? What are we saying in a year's time? Like we knew it was a transitory inflation. We knew it was AI But what, right? Trying to drill down on what that actually looks like. What? So thesis, obviously, again, real estate. So real estate's not going away. So we know that's a component of everything. That's what you do. That's your day job. We know that. But for the other piece of the equation, like where else do you look? And what are we going to be seeing in a year? Again, guessing. I know there's no crystal ball, but guessing what that looks like. What are we saying we got wrong in a year?
So I'll bounce around different kind of market variables, and especially I focus heavily on the U.S. markets, and at this stage, what I'll say is this: is that when we hear Janet Yellen and then Jerome Powell start yelling at the top of their lungs, inflation is transitory, we know because it's historical data, we can literally date to date it, right? That 9.1% inflation happened 18 months later. So I don't know what your definition of a transitory is, JP, but it sounds like it's probably close to mine.
That's right.
That sure as hell is not transitory. And now we fast forward to today, right? In the US, our most recent reading, I think, was 3.8% for inflation. Okay. The Federal Reserve has a dual mandate in the United States, where there's two things that they are tasked with performing on a day in and day out. One is the stable currency perspective. That's a 2% inflation target. The other is stable employment. That's an unemployment rate right around 4%. Okay. So we know that a 3.8% inflation reading is way off the charts for what they're trying to target. On the other end of the spectrum, unemployment, what's that at? In the US, that's roughly 4.3%. That's much closer to target. Historically, what we know is that when inflation is majorly out of whack, that you raise rates, right? That's the lever that you pull in that situation. So when in historically, like in the 1970s, late 1970s, early 1980s, rates went up to 20+% when inflation is at 10% plus, right? Today, we're just not, even though the Federal Reserve, the Federal Open Market Committee, the FOMC has, what is it, a dozen seats, 14 seats, something like that. The vast majority of those that sit there are hawkish. They are pro focusing on inflation first and unemployment second. And historically, that does appear to be the right move. The reality is they don't have the guts or the whatever gusto to actually stand by that decision and raise rates. Again, I'm a real estate guy. Higher rates doesn't exactly benefit me to say it's the right move, from a day-to-day perspective, but that appears to be what's happening. If you wanted me to read one level deeper, I believe there's political influence that's playing
Yes,
right
of
now.
course. Yeah, we've got that in play as well. Well, Warsh just comes in. Do things change under his watch?
So, I love this deep dive. This is a big question. So, Warsh, what's funny about Warsh is if you look at his background, he has a few things going for him. One, and I'll give you three good things about Warsh. One is that Warsh is arguably, and I don't know, maybe not even debatably, the most seasoned to step into the chair role that we've ever had in the United States. He's also an economist by trade, which is a change. Jerome Powell was an attorney, the first attorney we ever had by trade. And, Warsh does have his JD, but he's really, an economist by trade. Two, he's the most wealthy. He's worth somewhere between 100 and 200 million. So the guy's not a dummy. Financially, he actually has a lot to lose. He's invested in the markets. He has a lot of money at stake. Three, he's good at marrying, right? Because his wife is wildly, I think it's multi-billionaire from, this is more of a joke than anything, but she's the heiress to, what is it, like a shampoo brand or something like that. I'm
I didn't know
spacing on
this.
that
I
one.
didn't know this side. This is interesting. Yeah.
So that was a joke. That's neither here nor there. It's just kind of funny and an interesting fact.
Well,
But what we
there's
know
wealth.
about
There, vast wealth. I guess is what we're saying. I mean, I think that Powell, was not unwealthy in his own right, but we're talking vast wealth, which is a change in perspective.
change in perspective and a lot to lose. And we talk about, there's this popularity of bringing up the robber barons, of the, years past in American history and how we're back there, blah, blah, blah. I won't really over dive in on that. But what's good about this is that Warsh actually has a lot to lose also. And if he's got a lot of skin in the game, then we would hope that with a huge background and a lot of money invested, that he would want the markets to play nice. He seems to be hawkish from his position.
It's interesting when you talk because there was all this discussion: is there political influence? But his first, his the first two things we're seeing are again hawkish undertones, which is it's just interesting, not what we were expecting.
And especially not what we're expecting, considering that the preceding comments from Trump we're very pro rate cuts. Now, the estimates on, again, 3.8% inflation today, the estimates are north of 5 in the near future. So this ain't going the right direction. This is not going a rate cut direction. And I think Trump, to whatever credit you can give him on this point, is he's laid off the gas of that rate cuts because it's just a road to nowhere. And he's got bigger fish to fry in the Middle East and other places, blah, blah, blah. I think Warsh, if we can pray for any outcome, it's that he does get to be hawkish if he needs to be, and that there's shackles off. And, the increasing political pressure we want to attribute to Trump. This is also a Biden era thing. This is also Trump V1 thing. This has been increasing over several generations of politics in the US.
And now it's macro in any event, right? So what's gone on in Iran, or what's happening with oil, it has to be inflationary. For what you're describing, it has to be. And I hear you saying, Nick, as well, that we're then talking increased rates. Like that's one thing we'll be saying, as I say, years time, like we're going to be saying rates are higher, whether we like it or not. And so plan accordingly, right?
And for a while, the Federal Reserve used supply chain issues in the 2000, the early COVID era. They said, well, supply chain, it's not our fault. It's not our fault. Yes, it was. You printed all that money, but we know that also today, geopolitics does impact inflation. For every $10 a barrel of oil goes up or down in price, that's equivalent to 20 basis points in inflation for the United States. So we are all tied in. We're all in the same basket here globally on that side. So the likelihood is upward pressures of inflation. The real question that I walk away with is, what do we do about it? We know that this is likely the weather that we're sailing into. So what do we do about it? Where do we navigate from here on that? And that's what we constantly try to crack at Saint as we manage our investment funds, et cetera, on that side.
Yeah, and that's long term. Again, real estate, obviously a component of it or a piece of what we're looking to do, right? Because they're not making more real estate, right? These are things that you can just plot away on, and I think that's what you guys have done quite effectively. So you put a proportion in that, and again, you plan for these higher rates, right?
Exactly right. And so on our side, we have an income fund. So our model is evergreen. We are looking 10 plus years in the future. My background was with 2 small family offices. What I learned from them, the biggest takeaway from these giants, in my opinion, these are men that I could not say enough good things about. I stand on the shoulders of perspectives way beyond what I should have had access to at that time, in the wake of 2008 when I kind of made my bones. It was think decades in the future. These guys thought intergenerationally. So on our side, we brought that same perspective to our income funds. And what we're trying to do is see around the corner is, what does a high inflation environment for the next maybe decade of upward pressures, whether they do rates and do different scenarios to kind of tamper that down, what does that do for us? On the real estate side, I can speak confidently and say, if you look historically, higher inflation typically, I mean this isn't radical saying, it increases the cost of assets, especially hard assets. So you want to be invested in hard assets because those typically will rise with inflation. Real estate's a good hedge for that. On the other side of that, there are going to be winners and losers. Office still has so many question marks we thought would be resolved by today, and they're just not. That's one end of the spectrum. On the other end of the spectrum, which is our darling today, is single family homes in the United States. And it's not revolutionary. It's that they printed so much money, in the early COVID era that single family home prices are up 47% across the country. So I get questions on webinars that we host for our investors that they're like, well, what happens if, home pricing goes down? I'm like, what? 3%, maybe 5%. If we're talking extremes, we're still at 40%, ladies and gentlemen. And on that, we still have the largest amount of equity in US history in homes because we've been underperforming on home development for a decade here, right? We're 4 to 6 million home shortfall in the US. So what we're looking for are supply demand imbalances in the real estate space, markets where there's a need that exceeds the supply. And that's simply put, and that's what we're investing to today because those needs are not quick. These are years that it takes to catch up on things like supply of homes in a local market. So that's where we're focusing right now. And with inflation on the rise, that actually benefits our position more than anything. So we're really liking, we're not rooting for inflation, but we are liking our position in the midst of the weather that's a lot bigger than us right
As
now.
you see, you can see the weather, right? So it's just the plan just for that. Regions, as you described this, what regions are you focused on, and where do you think that the largest gains stand to be made?
So it's funny because in the US, sometimes we have a really short-sighted view of markets, right? Oh, quarterly earnings, 3 months. The last 3 months looked like this. What we're seeing is that markets that overdeveloped but still have good fundamentals, even those markets are weathering the storm really well. So we saw Phoenix, for example, way overdeveloped, something like 20 to 40,000 units, depending on how you calculate that. Way overdeveloped for what their local needs were. But what ended up happening was that brought down the price of shelter, aka apartments, homes, etc. It brought that down. So more people were able to move there. So more businesses moved there, and it's a business-friendly state. So all of a sudden, you see that balancing out because the fundamentals of that market, pro-business, pro-growth, etc., seem to work out. On my side, we do invest nationwide. It's really deal by deal basis. We invest in mortgages. So we're investing in low LTVs, really conservative, stabilized deals on that side, backed by single family homes. I still like pro business, pro growth, job growth markets. What I'll look at as a secret metric, JP, is if the local wage, so in the US, we know what wage growth is. It's roughly 3.6%, right? We know that when inflation exceeds wage growth, quality of life diminishes. It has to
Buying power is
because
down, yeah, for sure.
buying power is down. Eggs get real expensive when you now know that everything else in your life is getting expensive at a faster rate than your wages are going up. So we're looking at markets that do have a degree of stability going into the future. So that said, the high priced markets, the real difficult to do business in markets, those are tier 2, 3 plus for us. Whereas the tier 1 markets are pro business. We still like our Texases, we still like our Floridas, we still like our Arizonas. I'm in California, not super pro business here, but there are some advantages and some necks of California where there's still a lot of business and a lot of
Yeah, because you've
entrenched
done quite a
business.
bit in California. Are you seeing the exodus that we're hearing of, or is it not as pronounced as it's otherwise being reported?
California cheats. I'll say that. I'll say that kind of a little tongue in
We've seen
cheek.
that, yes.
Yeah, and so California cheats in a few ways. I still like industrial in California because we have two of the biggest ports in the U.S., right? We have the Port of Long Beach, Port of Los Angeles. Imports, if there's one thing we've learned, it's that while the rise of manufacturing in the U.S. is so needed in the world that we're in today, the reality is there's still massive amounts of imports. And between the Port of Long Beach, between the Port of L.A., any given year, it's in that 30% plus of entire U.S. imports through those two ports. So it's so condensed that there's still so much, what is it? We're in a 40 million person state. 60-ish% of that population is in 5 counties in the South. I mean, you got a lot of people that are entrenched there. My concern long term, kind of to where you're speaking to, JP, is what happens when the net contributors to tax start leaving the state at a high rate.
Right, and it's going on now, right? There are people saying, no, there's too much tax here. As you say, there's some things broken or some things that need to be fixed and looked at, and that's what happens. Even states are competing with each other for those people, right? They want to be pro-business, they want to attract, and you can make a decision as to whether or not you want to be there, right? And obviously, California's got to do something on that end of things as well.
And Texas doesn't even hide it, man.
They
Right?
flaunt it.
Texas, right?
They flaunt it. They're saying, okay, come over here then. We'll do it this way here, right? We'll do it our way here. Again, pros and cons. We can get into a whole
Yeah.
debate, but we're talking about markets, and what's going to happen. And on that front, you talk imports. The U.S. dollar so important, from many perspectives. But what do you think we're seeing the U.S. dollar? Is it going to continue to devalue? What do you think it's going to look like again in a year's time?
So there's an old Warren Buffett quote that makes me want to throw up, but it's also very applicable to what we're talking about now. He says the natural course of government is to make the currency worth less over time. And if we think about that in extreme situations, it's to make it as close to zero as they can because they overspend, right? So they're paying back that cheaper debt. What we know in the US is that our debt is out of control. It was already out of control, and now we're in a war that costs $1 billion a day, right? We now are also in a position in the US where central banks hold more gold than they hold USD.
Right, that's new as well, isn't it?
That's very new. And so that's unsettling. This is a scary trend. The benefit that the US has in all of this, and I'm still very bullish on the U.S. I'm still very positive of the U.S. as much as I, beat up.
Yeah, of course. So
Especially
you're talking macro, and you're being realistic here, and you're being wise as you approach it. So it's still good to be bullish. Obviously, it's the largest economy in the world.
and so that's largest economy in the world. I think Americans at their core have this ability to really truly figure things out and put their nose to the grindstone and work on it. So I'm personally passionate about things like entrepreneurship and investment education because I think those things are underserved in the US. But when you apply the US economy, when you apply the business force of the United States, when you apply that the US has a democratic society, which is certainly not as unified as like a China, right? Which can make quick snap decisions that last for decades and they can really plan significantly in the future. Whereas in the US, we have to fight it out every 2, 3, 4 years. The good news about the US and in our political system is it can bend a lot without breaking. And it naturally, if it's running its course as it should, it bends a lot and adjusts in the right direction slowly over time. So I do think that the US will adjust here. My biggest concern is on our debt, bar none. Whether it's, social or political or whatever it is, it's the debt to me. Because the last presidential election that we had Kamala Harris versus Donald Trump. The debt didn't even come up in the debates, JP. We're
Yeah,
talking we're talking debt out of control, printing 2
well, it's
trillion a
not. It's
year.
not. There's no political, currency in discussing it, and it wasn't what it is now. Was part of the other issue, right? You can't ignore it.
And and the problem is the places that we would need to make cuts are things like Medicare, Social Security, defense. We're in a very hot world right now. We ain't cutting defense, right?
Sure.
Like we're not seeing that, be on the chopping block. So what this all does, if we speed up the clock, and again, I'm kind of doom and glooming it, but I'll give a little bit of positivity as a backup. When people feel stressed at home, they have less kids. That's not revolutionary, right? What we know in the US is our fertility rate, aka the average amount of kids that the average female has, is roughly in that I think it's 1.6, 1.62 in the United States. Replacement is 2.1. So what that means is if we want to keep up our population, there's a mandatory inclusion of some kind of immigration strategy. And in the US, the two things that we've seen politicians immediately not ever want to solve are the debt crisis and the immigration crisis. So those two things, I think it's whichever party can lean into those and actually soberly have real discussions on how to solve those issues on the debt side, really meaningfully cut debt or cap debt and do that over a long period of time. And then two, have a meaningful immigration policy. Canada has a fantastic points-based, merit-based system where they look at all kinds of factors and determine where people should be immigrating from, what their future culture will look like. I mean, these are smart perspectives on immigration. In the US, we just don't have that. We're not able to have those discussions. If we solve those two, I think things like inflation and things like long-term perspective get worked out naturally. Those are my
Yeah,
bets.
yeah. I mean, they certainly. Yeah, you're right because it alleviates a lot of those pressures. That being said, I think it's a lofty goal. I mean, I know you. I mean, what you just described, the politicians know them. At least the smart ones know themselves as well, but they can't get elected, right? And those others that are voting for them are not willing to vote for people who are looking to fix those problems. Let's park those on the side because, as I say, those are big ones that I don't know if we're going to resolve, but they do impact
Sure.
the dollar, right? So we haven't really sort of drilled down on what we think the dollar is going to look like because part of what you just described as well, part of it could be solved by devaluing the dollar. There's a lot of people saying that that's what's occurring as well.
Oh, I couldn't agree more. I think it's a systematic devaluation of the dollar. I think it's a strategic um, debt-based decision to devalue the dollar. Again, we lightly touched on it, but if you take a dollar today and look at a dollar in 1913, $100 today is $1 in 1913, right? So the dollar's been devalued, and since 1971, when we got off the gold standard, the vast majority of that occurred. So now we're in true fiat, wonderland here, where the value of the dollar is determined by how much is in circulation, and we're pumping those numbers up every year. So my bet on the dollar to kind of put it on the nose with exactly what you were asking. I see more of the same, unfortunately. I see more of the same. So for
Just
investors
a
to,
gradual bleed, though. You don't see that. You don't. You're not going to be a correction then, or there won't be something where people just decide to move away from the dollar.
well, we've seen that gold has already moved away and that central banks have already moved away from the dollar as their, the dollar versus gold holdings. But here's what I'll say is I don't think it's that the US is perfect today, the reason that it's still the reserve currency of the world. I think it's just there's not really a second option. If you really drill down, it's not that the US is so great, it's the comparative options are just not in the same universe of strength as the US dollar in those ways. You could talk about the euro, just no. And again, I have a lot of family, in the European Union. DeAngelo is not a native, American last name. We came through Ellis Island like everybody else during that era, and the euro is just not going to step up. That's just not a possibility. It's 27 different member states, different bond structures. It doesn't have a unified, bond structure like the U.S. has, et
It's not
cetera.
there, and I don't think it's not the sort of the power. There, you need to be a hegemony, or there's some discussion is are things going to be repriced in the yuan, and they're trying to do some oil in yuan right now, but I don't know if that occurs either. I know you're not a big crypto guy. Have you ever put your mind to or thought of how, well, among other things, the stable coins are being used and how they're being backed by U.S. debt?
So crypto's one that is very interesting to me. And I think the technology behind crypto unquestionably has applications even beyond crypto that is game changing, world changing, finance changing in a major way. On my side, here's what I'll say is that because there's so much nuance and so much depth to the crypto space, I'm real boring and I stick to the winners. You know what I mean? And in my mind, Bitcoin is that winner. My average holding in Bitcoin was, an entry point of roughly 20 to
Oh,
28,000
you've been
is
at
kind
it
of
for a
right
while,
around
and good for you. And so, do you consider that to be a hedge against inflation then as well?
100%. And the reason gold is great, and if you zoom out thousands of years, gold was the reserve currency of the world at so many different phases. But I mean, what's the practical application of gold, JP? It's okay. You want your life savings in gold? Are you gonna, you know, you're going to throw it over your back and walk around and trade gold? No, not really. And what I like about crypto is it really truly has the ability to trade internationally in a very real way, quickly, efficiently, safely today. And all those things being the case, I like crypto for those reasons. There's a lot of chaos with things like the crap coins and other parts of crypto, but I really don't see those as core strength of crypto. I see the core strength of crypto being hedge against inflation, extreme tradability, extreme liquidity, and I think you need those components in your portfolio. And so for that reason, yeah, I hold Bitcoin 100% exclusively. I'm not really diving into other areas, but the stable coins a little outside of my purview. But what I'll say is that it's getting very interesting what I'm reading and slowly catching up on there. And I think there's strategies, governmental level strategies to have stable coins built into a system. I don't have any idea of a crystal ball on that one though.
Yeah, and I mean, it's a question of watching, right? Because we're getting some regulatory clarity now, right? The very Clarity Act, or we've already got the Genius Act, the Clarity Act. Looks like we're going to see it through. I think the banks need to be aware, right? They're fighting for their territory, but from what you're just describing, I think you're quite right. There's another set of rails. There's another way, right? This cryptocurrency and Bitcoin being the granddaddy of them all. They're only making like land only so much. Bitcoin as well, right? So we know we've got 21 million. People are parking up a part of their portfolio in that as well, right? We talked real estate. We're questioning equities, looking at what equities looks like, and of course, we got to park a little bit in Bitcoin as well. Any other area you look to?
Yeah, in the investment side, I'm liking. Right now I do have my eye. I'm super partial towards industrial. I do think that the upside for the future of the US markets, especially and really globally, I think a lot of it's going to be leaning on industrial, whether that's, AI data centers, whether it's manufacturing and that getting less global and more regional, whether you're talking the really heavy industrials like rare earth metals being divested away from China. I think the future of the world is going to be looking a lot more industrial on that side across the board. And frankly, I think we have a national security problem in North America by not having a more manufacturing in North American, in the North American neck of the woods. So for all those reasons, I really am pro industrial. I think that will really, really be a future for the next 10 plus years. I have my eye on AI. I mean, probably like everybody else, I'm 50% holding my breath and 50% expecting, a revolution of change across business. And so I have a big eye on AI. And then, yeah, a lot of it is,
Well, and
seeing.
Nick, when you say an eye on
Yeah,
AI, how do you mean? I mean, we're all watching, and hopefully participating. We're spending some time on this show, making sure
sure.
people are aware. It's hard to go without seeing the beginning of the impact this has, and then starting to imagine how great that impact is going to be. So, as you say, keeping your eye on it, what are some things you're looking to?
Yeah, maybe I underplayed that a little bit. We're extremely involved in it.
That's right.
Right. So when we say keep an eye on it, or what I really mean by that, a little tongue in cheek, is we've dove in dramatically on AI, and really on our side, it's everything's about data. We want to know who's used it, what they did, what the outcome was, and what that looked like. What you see is this it almost seems like the tale of two cities. Things are so far apart that they can't exist in the same universe, but alas, they do, right? So what we've seen is that you have the MIT study that anybody that hates AI is going to point their finger at and say that 85% of companies that applied AI found significant reduction in performance, and they found all that. And you look into that study and you squeeze it down a few more layers, what you find is that the application was garbage, and that employees pushed back, and there wasn't a clear reason why they were doing it, and there was no leadership that owned it. And what we're actually seeing on, boots on the ground on our side, competitors, the real estate space, the investment space, is AI is revolutionary, but it's not replacing jobs in the same way that the fear mongers are saying. What we're finding is that the application of AI saves infinite hours, and it saves infinite spot checks, and it saves huge amounts of these deep dives on data that's so dense. And what we found is that the best in our instance, and in many of the investment world's instances, the best application of AI is taking huge amounts of data, distillation, finding trends, and spot checking that with human understanding. And with that, we found outcomes fantastic. That is, automations, that's already been proven for AI. There's not, that case study is already stamped, right? For the replacing of people, we don't see that as much. We see more so that the human component is significantly supported by AI, and that we are getting extremely efficient. We underwrite hundreds of deals at a time. We have, constant deals out in the real estate space. That is much more efficient. Let's say it's a tier two market that we don't have huge exposure to. We can catch up in minutes instead of days, right? And then a human element overlooks that, or oversees that and catches up on that. So I'm extremely optimistic on that. I'm extremely pro AI on that. And the bigger wrestling match that I have mentally on that is, it's us versus China, if you want to think of it that way. That's the headlines that, it's being proposed as kind of the rumble in the jungle of the AI war. But the reality is, I actually do believe that we need to be on top on AI. I think North American AI needs to be up there. I think that we're starting to see the NIMBYism of local politics, where it's like, not in my backyard. We don't want these data centers here. And then again, back to the industrial component, how the hell do we have the energy for this? There's a fundamental miscalculation of how much AI we need and how much processing power we need with how much energy we can actually perform on. It's nice to say that the United States and North America are energy independent and we have enough oil. That still doesn't get us to the needs of
It's
AI.
nowhere near is what we're being told, right? And if we're listening to the experts in these areas, that there's nowhere near the power required to run the AI. The AI needs that are only going to increase. So I'm sold as well. Obviously, we spend time here talking a great deal on AI on the show itself, and it's here. Like, for those that aren't embracing it, they're going to be left behind. It's the people that are using it. They may not lose their job, but the people that are using it effectively are the ones that are going to outperform. And so you need to be there. You need to be using it. So when we're talking that power, I guess maybe there's some opportunity there when we talk about the equities, because there's that mispricing, right? Or we don't have all the AI power available to us. And so we're going outside of grid. We're getting companies looking to nuclear, certainly gas producers. You got none of them trying to actually go straight to the data center, right? They're trying to provide the power straight to where it's required, as opposed to going through the grid, which itself needs to be updated. So if we're looking again in a year or two from now, how much of these data centers, I mean, I know, again, not your area of expertise, but you're looking at real estate, how much of these data centers are going to be built? How much is this actually going to come to fruition?
Yeah, again, a little outside of my confidence circle, but what I'll say is this, is that the vast majority I don't think happen. And here, I think there's three reasons for it. One is going to be the NIMBYism, the not in my backyard aspect. And to be clear, this has been brutal for a lot of communities in the United States. You see people in rural Indiana, I think is the most recent study, their local electricity bills went up to like 800, $900 a month, right? From you're talking $100 a month, $200 max. Like, so you saw a 4+X increase in electricity. They are subsidizing that local infrastructure. They're subsidizing what that looks like. On our side, and that's number one. Number two is I don't think there's enough energy available. You said it. You said where my head's at, that at some point we need to have the nuclear discussion as adults and get to a point where there's long-term power solutions, there's long-term power strategy, and that electricity really, energy needs to be a top priority moving forward. And we know that from the Strait of Hormuz, is that when 20% of the energy in the world, in the oil world, is constrained, the whole world feels it. We need to get away from that. And then three is, I think, the technology and the chip manufacturing, et cetera. We need to get back to having a better control of that. We have conversations of if China takes over Taiwan, and it's screwed for everybody, and China has the monopoly on it. Between those three things, it's a really unsettling perspective and a projection on that. What I'll say is, we make the designs for the highest level chips in the United States, so it's North American based. I think that's pretty damn good. As far as energy, we're energy independent. I think that's pretty damn good. I think we have some political, movement to get over some of the nuclear power questions, and I think we can get there. And then number three, the NIMBYism. At some point, there needs to be a bigger ownership and a bigger push at a larger level with governments to be getting these things done, knowing that this is national security and long-term, perspective and economic outlook, that we need to do it. Where it needs to, be on that side and support communities to be able to doing that. If those three things are solved, I think we have a very, blue sky future on that, and we will beat China and be the AI leader on that side. If not, and we falter on those, then, it gets a little funky.
It gets a little funky, yeah. And I think you're quite right. I think that we do get there. Obviously, huge issues that need to be resolved, but we're working on them, and I think we're going in the right direction. That much is clear. These kind of this is such a helpful discussion. I think for those listening as well will agree. We're talking about what the future looks like, right? Trying to map what that looks like. We know how important AI is. We know that cryptocurrencies are coming, and we always know that you got to keep some powder dry and maybe keep some traditional investments as well to help the whole portfolio move along. Nic, it's been great talking with you on all these discussion points here today. If somebody was interested in digging a little further, in particular on the real estate side of things, how do they get in touch with you?
The absolute best thing that we can offer for anyone who, if somebody really enjoyed a discussion like this is a niche discussion, JP. We actually have a book that we just released called Economics Over Politics that takes the biggest economic trends in the United States that are not being covered in the news, right? We're digging into the real wheels turning in the housing market, inflation, et cetera, and then also how to invest through those. We have an entire book on it, 220 pages, Economics Over Politics. They can get more information on that at saintinvestment.com/book. I highly recommend it. We're the bestseller in 3 categories for economics. So it's a great book, and it really deep dives on these topics.
Fantastic. Thanks for that. Anyone listening, do go grab that, and we'll have everything in the show notes there as well. Nic, you've obviously dug in deep. A lot of it, a wealth of topics as they come together to form what the future for us looks like, right? I like to end these episodes with one thing or something you've heard along the way that's really informed you and really led to your own success, something that maybe somebody here listening, if they hear it, will apply in their own life and take them to the next kind of spot. You did some incredible things in the family offices. You built your own business from here. What could you say to somebody listening that's something they could do for themselves to move themselves forward in the next year or 5 years?
The number one thing that I can give advice, and again, it does come from the family offices, this isn't even directly from me, is that thinking about investments on a 10-year horizon gives you the stability over the long term to both be amazing at what you're doing today and also have stability over the long term. You consistently see the best performers do that. We do that at Saint. If there's one piece of investment advice that I would suggest people consider, it's think about investments over a decade. And if it's something that will weather the storm very likely over the next decade, then it gives you a lot of stability and a lot of benefits sleeping well at night.
That's great stuff. Thanks so much, Nick. We loved having you on the show. We look forward to next time on the Millionaire's Lawyer.
JP, I had a blast, man. Look forward to talking to you again soon.